Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lyft.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our efforts.
And if there's any stock you want us to look into, just leave it in the comment section below.
So let's get into the analysis.
For a long time, the story around Lyft was, all about survival.
Right, just trying to stay in the game against a much bigger competitor. But something's clearly changed. When you look at the financials, the shift is pretty dramatic.
It's fundamental. We're talking about a pivot from just surviving to being a legitimately profitable, compounding platform.
And the proof is in the GAAP net income, right?
Exactly. The swing is massive. In 2023, they posted a loss of, about $340 million.
A number that scared a lot of people off for years.
Understandably. But then they executed this sharp reversal. They closed out 2024 with their first full year of GAAP profitability.
And what was the final number?
$22.8 million in net income. It shows that the platform's operational leverage is finally, kicking in and delivering to the bottom line.
Okay, that's a huge change. But profitability on its own doesn't convince me if the user base is flat. Is this just cost cutting, or is there real growth?
This is maybe the most compelling part. The demand is actually accelerating. For the full year 2024, rides were up 17% year over year.
17%. That's a big number for a market that feels pretty mature.
It is. 828 million rides in total.
And is that momentum holding up?
It's getting stronger. If we look ahead, active riders in Q3 of 2025 hit an all-time high of 28.7 million. That's an 18% jump year over year.
So the growth rate is actually increasing.
Yes. Demand isn't fading, it's strengthening.
Okay, so if demand is accelerating, it has to be because of the service itself. You don't get that kind of loyalty by just, playing with prices. What's management saying is driving this?
They're pointing to two things. First, service quality. They claim they achieved the fastest average ETAs in the industry in the fourth quarter of 2024.
ETAs, so estimated time of arrival.
Exactly. If you as a rider know you're going to get a car faster on one app, that becomes a core part of your decision.
Faster ETAs are basically the holy grail here. But how are they doing it? Is it just more drivers on the road, or is there a tech advantage?
It seems to be the tech. They launched a new integrated supply management system in 2025.
Okay, what does that actually do?
In simple terms, it uses machine learning to get much better at predicting where demand will be. And then it matches drivers to those spots more efficiently.
Which means less wasted time for the driver, I assume.
Precisely. It cuts down on what they call deadheading, that's driving around without a passenger.
Right.
So drivers make more per hour, they're happier, they stick around, and that means more reliable supply for the riders. It's that virtuous cycle.
That makes sense. Let's talk about those drivers. The supply side. 44 million annual riders is a strong demand signal. But the real moat is keeping the drivers happy, right? How are they winning that war?
The data they're putting out suggests they're winning the preference war. They cite internal surveys showing a 16-point advantage in driver preference over the main competitor.
A 16-point advantage? That sounds good on a slide, but I'm a bit skeptical. What's to stop their competitor from just throwing $1 billion in bonuses at drivers tomorrow and erasing that gap?
That's a fair challenge. And look, part of it is probably economic, but part of it seems to be structural. The new system means drivers are genuinely more efficient on Lyft. They waste less time.
So it's not just about bonuses.
It's not just about bonuses. You can't just buy that kind of operational efficiency overnight. If drivers consistently make more money per hour on your platform, that preference becomes sticky. It's harder to just buy back.
Okay, that makes the story more robust. Let's switch gears to the financials beyond just GAAP. For a platform like this, it's all about margins and cash flow. Is this growth actually generating real cash?
It is, and this is where it gets really interesting for investors. The implied gross margin is sitting around 42.6%, which is very healthy.
And the free cash flow.
That's the real headline. For anyone who remembers the cash-burning IPO days, this is a different world. Trailing 12 months free cash flow is about $958.6 million.
So almost $1 billion in pure cash. That's a massive turnaround.
It is, and Wall Street expects that to keep growing, maybe to around $1.3 billion by 2028. This signals that they are now fully self-funded, no more relying on the market to raise cash.
I do want to flag one thing, though. The current ratio looks a little lean, around 0.7. In a normal company, that might be a red flag for liquidity.
That's a great point, and it's about understanding the business model. For an asset-light marketplace, that's actually pretty typical. They don't have inventory.
So their cash comes in faster than it goes out.
Exactly. They get cash from riders instantly, but they pay out to drivers on a cycle. So that strong operating cash inflow, which was recently $291 million,
Mm-hmm.
completely mitigates that lean current ratio. It's a feature of the model, not a bug.
That makes sense. So they're stable, profitable, and growing here.
Yeah.
But what's the long-term vision? How do they win the next phase, which is all about autonomy?
This is probably the most interesting long-term catalyst, and it's a very smart capital-light strategy. They've partnered with Baidu on robotaxi tech,
Okay.
and they're targeting Europe for expansion, starting with the UK and Germany from 2026.
So why is that a better strategy than, say, building their own self-driving cars like some of their rivals have tried to do?
It's all about risk and capital. Building an autonomous division costs billions in R&D with no guarantee of success.
Right, we've seen others struggle with that.
So Lyft is sidestepping that entire R&D burn. They're letting Baidu handle the expensive, difficult tech development. Lyft just provides the platform, the network of riders, the operational know-how.
They're renting the moat instead of building it from scratch.
Precisely. It allows them to become a global, autonomous-ready platform without the massive capital risk. It's a classic platform leverage play.
Very smart. Let's bring it back to the near term. What's the guidance look like? Are they going to keep balancing this growth and profit?
The guidance suggests they will. For Q1 2025, they're expecting mid-teens rides, gross bookings of around $4.05 to $4.2 billion,
And the bottom line.
and adjusted EBITDA in the $90 to $95 million range.
So what does that work out to in terms of margin?
That gives them an adjusted EBITDA margin of about 2.2 to 2.3% of gross bookings. So the takeaway is, yes, they're maintaining that double-digit top-line growth while also expanding profitability. The story holds.
Okay, let's look at the chart. The stock has had a phenomenal year, but we've seen a pretty sharp pullback recently.
That's right. Year to date, it's up about 48.9%, a really strong primary uptrend. But over the last month, it's corrected by about 16%.
So for an investor looking at this now, how should they read that? Is that a warning sign or an opportunity?
I view it as constructive, healthy technical action. A stock doesn't go up in a straight line. After a run like that, it needs to cool off, consolidate, and shake out some of the short-term traders. It's building a new, higher base of support.
And what's Wall Street's view on where that base should be?
Sentiment has definitely turned positive. We're seeing a lot of analysts raise their price targets, and they're clustering in this, say, $15 to $22 range.
But I see one target out there from TD Cowen at $30. That's more than 50% upside from here if the story plays out.
It is. So for investors, that $15 to $20 band becomes a really interesting area to watch. It's basically where the consensus says the stock's fundamental value is right now.
We've laid out a pretty bullish case, but we have to talk about the risks. Let's start with the big one that never goes away. Regulation.
It's always there with the gig economy. Any changes to driver classification, minimum pay, insurance costs, all of that could hit their operating costs hard and pressure those margins we talked about. It's the key risk.
And what about competition? They're still not the biggest player in the market.
Competition is intense, and their rival has deeper pockets, so there's always the risk of a price war, either for riders or drivers, which could force Lyft to sacrifice some of those hard-won profits to defend their market share.
Okay, now 2 caution points on the stock itself. First, the valuation. Even with the GAAP profit, the PE multiple is still high, around 59.
It is high, and that tells you the market is pricing in a lot of future growth. It's not paying for today's earnings, it's paying for the earnings of 3 or 5 years from now.
Which leaves very little room for error.
Exactly. Any small miss on guidance and the stock could correct sharply. It's priced for near-perfect execution.
My second point is the recent insider sale. A director sold almost $4 million worth of stock near the recent peak. That never looks great, does it?
It's definitely something you have to monitor, and the optics aren't ideal. But it's important to keep it in context. It was a single director. That can happen for any number of personal financial reasons that have nothing to do with the company's outlook.
So it's not a red flag unless you see more of it.
Right. If you saw widespread selling from the executive team, that would be a major warning.
Yeah.
One sale is something to note, but it's not a thesis breaker on its own.
So with all those risks, regulation, competition, valuation, what's the ultimate safety net for an investor here?
The safety net is that new financial reality. Positive GAAP earnings and nearly $1 billion in free cash flow. That cash flow gives them a huge cushion to absorb a regulatory hit or fight a price war without having to run to the market for more capital. The story is just fundamentally stronger now.
So, to sum it all up, it seems Lyft has really pulled off a major turnaround. We're seeing accelerating rider growth, a move from burning cash to generating nearly $1 billion in free cash flow, and a smart capital light strategy for the autonomous future with Baidu.
The consensus on the street is definitely shifting. This has gone from a high-risk survival story to a high-margin mobility platform in the making. The framework for sustainable, profitable growth is now in place.
If you enjoyed this analysis, hit that subscribe button, leave us a comment, and join us next time on Smart Wealth with Joshua.